We have talked in the past about the F and Z score, and given the fact that this is the beginning of October, I wanted to walk you through a couple of these companies. So what we are looking at right now, this is a list of 10 companies that have an F score. That is the Piotrowski score. It is a 9-point score of balance sheet improvement year over year. You can look at this on Guru Focus, and basically every time that the company does something right, out of these 9 points that Joseph Piotrowski, a former Stanford and University of Chicago professor, created, improving return on equity, not issuing new stock. That's an important thing. Not taking on more debt. That is an important component of the balance sheet. You want the companies that hit all 9 of these provisions. All 9 of them. Not 7, not 5, not 2, definitely not 1. All 9 of them. That means that they are stronger than they were last year. Their balance sheet has improved and they look better for their future, even in this environment. And that's an important thing to consider. These companies are good performers in this environment. And that is what I want you to take away from this. The Z-score is a weighted average of 5 different components, and that tells you the probability that the company will go bankrupt, right? Or that it will be insolvent. And typically, our line in the sand of what we want to own is anything over 2.6. That seems to be the Mendoza line of a predictability of whether or not these companies may face credit challenges. And in this environment, where we're talking about serious liquidity challenges, where we're talking about companies having to pay more money for debt, where we're talking about the Fed needing to raise interest rates, possibly another 50 to 75 basis points in November, possibly another 50 after that in December. We just don't know. But this type of environment makes it very, very difficult for companies. Well, anything over 2.6 is kind of our safety line. We like to go up to above 2.99. So anything of 3 and over creates a little bit more of a safety buffer for us. And this month, the F score of 9, the Z score low of 3 or above, and then you add in a valuation metric. Relatively simple, right? So we may use something along the lines of tangible book value. If we're looking at banking companies, we may look at companies that have good enterprise value to EBIT. If we're looking at potential buyout, low multiples compared to other companies in their sector, anything with an F score high, that's probably going to knock out a lot of banks. So again, keep that in mind. You're not going to see a lot of banks on the value side when you do this. What you're looking for instead with banks is stocks that are trading under tangible book value of 1. That's a good way to measure value. We'll go over that next time that we have a conversation with Tim. But right now, you're seeing in this space, this month, what is really improving, what has really been stronger. You're seeing things in transportation. You're seeing things in energy. You're seeing things in companies like CFN Industries, which are involved in the production of agricultural chemicals for the purposes of growing phosphates, things along those lines. So all of these companies coming off those oversold conditions that we saw on Friday, combined with good balance sheets and capital coming into the market, have produced, in this case, 4.9% move today. So Devon Energy, which is already rallying, and as you can see, you've kind of taken this top here on Devon at about $73. If you profile Devon, you've got a stock right now, DVN, you got a stock right now that's trading at $68.50 with a 0.8% dividend. Now keep in mind, this thing's not going anywhere. It's got a great balance sheet. It operates in the Permian. It's got a low PE ratio. This is a company that makes things that we need to survive. And energy prices kind of finding their floor recently, despite the recessionary concerns. Devon Energy has been a best-in-class stock. It was one of the best stocks that we traded all of this year at the beginning of the year. And now that kind of all of the speculation has been removed from the backside of the war at the beginning of the year, now looking at a good company in good fiscal shape, heading potentially into a positive momentum environment. Well, do you want to own this stock and try to buy a call in this scenario where it's still elevated. It's still very, very elevated to right now because of the high volatility in the market. It's expensive to buy calls on Devon Energy, even if you have conviction heading into next week. So next week, I think that Devon could hit 70, 71. But the idea that I'm going to pay and go maybe out of the money to speculate on it, well, if I buy the $69 call one tick above where we are, look at this. I need this to break even at 71.36 by next Friday. That doesn't do me a whole lot of good because I just said to you, this stock is effectively topped out in that $72 area. So let's just say that it gets to 72 by next Friday. What type of return am I looking at here? If it gets to 72 by next Friday, my possible return here is only 27%. And again, we just mentioned this a second ago, right? FinViz, we look at DVN, you see the company sitting right here. It's already had this rally, and this has kind of been the range, that's 72 to 73. Let's change it to 73 just to see how great of a return it would be to trade the $69 call out of the money for 2 Fridays from now. Well, 70%. Okay, I can make $164 on that, but it better get there fast. It better rally. There better not be any negative moves. And the probability of profit here, right? We're going to get into the money is 34%. Well, remember I said that the dividend itself was 6.8%. And I also said great balance sheet, great Z-score, low EV to EBIT. We have a cheap company despite the fact that people are worried about recessions. It's making a product that we need. That's really important. We have the MACD crossover already happened. It's made these gains. Well, couldn't I find a way to improve my ability to make money, have a higher return on my investment than just buying the stock, pick a spot where I am content to own the stock, and in the process, generate a dividend higher than what the company makes. And this is where the put spread strategy kind of comes in. So $68 right now, $68.70 is where we're sitting according to this. I think it was at $68.80 a moment ago. But let's go out to October 21st. We'll just go out to October 21st. We don't have to stay there. But hypothetically, let's say we went down and we sold the $62 put. And again, we're only going to have about a $200, $300 trade, but I'm going to show you what this looks like. So the $62 put, and then maybe you buy the $59 put. Okay, so what does this create for us? It creates a small spread, and I need to write that. And I need to buy this. Forgive me. So I'm buying the 59 and I'm selling the $62 put. Okay, real quick. It will require me to put down $255 as a margin. I will generate off this trade if the stock remains above 61.55 by October 21st. And based on historical volatility, 81.1% probability of profit. And this is selling a put spread. Okay? Now, what happens in this environment? If the stock falls to 61.55, I need to either close the position or buy the stock. If it falls under 62, technically, that stock can be assigned to me at any given time, but or ahead on or before the option's expiration date. But by owning the $60 put, selling the 62 and buying the 60, if the stock were to fall under 60 today or in the next 3 weeks, lose my maximum risk. That's $255. Why does that matter? Well, it matters because if you bought 100 shares of this stock today because you really want the dividend, you really like the company, you think that it's going to be this great trade, imagine for a moment that you bought this stock at 68.60 or 68.60, where are we right now? Forgive me. 68.70. And this stock, for some reason or another, fell to 58.70 by October 1st. You would lose $1,000. You lose $1,000. Now, in this situation, rather than having all of that in place, you're going to be able to have the right to 100 shares, if it falls below 162. You're selling someone the right but not the obligation to sell you the stock on or before the expiration date of October 21st if the stock falls at 262 or below. And you have the $59 put, to protect yourself if it falls under 59. Well, if it fell to 58.70, you're down $1,000. In this situation, you're only down $255. But if it stays above 62, you're going to make your $45 on your $255 in risk. You're going to generate 17.6%, which is double the dividend, more than double the dividend, nearly 3x the dividend, and you have a higher probability of profit. And if the stock goes up, let's say the stock does go to 72. Well, that's where the other bonus kind of comes in. Because if this stock were to rally tomorrow to 72, you can sell this thing back at any time you want. You can buy back the put that you sold at a lower price and sell back the put that you bought for a lower price. And doing so, you don't have to wait the whole process for all of this capital for you to be able to keep it. You can take your $35, $36 rather than waiting 2 more weeks for your 45. So a 75 to an 80% return, or maybe even a 65 is what I prefer to aim for. Then you move on to the next trade. So if you're a more conservative trader, if you like certain stocks, you can use this strategy instead of just buying or dollar cost averaging in or buying 100 shares here and setting targets at other places. Using the leverage of options requires less capital to do this, and you can pick your targets with specific dates around the third Friday. And in a lot of other companies that are more liquid, you'll have weekly options. And in some cases, you'll have opportunities with some of the index funds that you can do 2 times a week, 3 times a week. And in the case of SPX, it expires pretty much every day. All right, it is 12:57, and I am realizing that Safari crashed, which means I need to go back into the room. So real quick on questions. Again, if you took the XLU trade, take the gains, right? What stock is Garrett going on about? I am going on about Devon Energy. And again, we just talked about other companies that have really strong balance sheets for the month of October. These kind of rotate portfolio, and in improving conditions, these companies are really, really strong. So these will be listed tomorrow in the midday momentum letter. There are some smaller companies in here, obviously, and you're looking at SPND and GFRY. Typically not names that I am actively trading, but UAN, absolutely. Huntsman, absolutely. Devon, absolutely. And PTSI was a great performer. Yeah, the trucking industry is a little tapped out right now, but again, improving balance sheet year over year. So these are the types of things that you don't have to just do. You don't have to buy and hold this stuff. You can trade around certain numbers to find really, really solid and conservative trades that have a higher probability of success.